Canada's housing market just hit one of its slowest sales periods in years, and in some major cities, transactions have dropped by over 20% compared to previous peaks. Listings are sitting longer. Buyers are hesitating. Sellers are nervous. And here's the shocking part. It's not just high interest rates causing this freeze. There's something bigger happening behind the scenes. Something buried inside the federal budget that could quietly reshape who wins and who loses in real estate. What if the real reason the market feels frozen isn't lack of demand, but a growing tax trap that investors, homeowners, and even small business owners didn't fully see coming? New capital gains changes, policy shifts, and mounting government spending may be creating a ripple effect far beyond what most Canadians realize. And when confidence disappears, markets don't just cool, they stall. So the big question is this a temporary slowdown or the beginning of a much deeper reset? Stay with me, because the details might surprise you. Number 1, capital gains tax shock. The first and arguably most powerful reason the market feels frozen is the sudden shock from changes to the capital gains tax inclusion rate. For years, many investors operated under a predictable system. When selling a property that wasn't a primary residence, only 50% of the profit was taxable. But now, with the federal government increasing the inclusion rate on larger gains, that equation has changed, and it has changed fast. Here's why that matters. Imagine you bought an investment property years ago and its value climbed significantly. Under the old system, you could calculate your after-tax profit with some certainty. Now the potential tax bill is noticeably higher. That extra tax doesn't just reduce profits, it reduces confidence. And in real estate, confidence is everything. When investors feel uncertain about future tax burdens, they hesitate. Some rush to sell before rules tighten further. Others refuse to list at all, waiting for clarity. This creates a strange effect. Fewer motivated sellers, cautious buyers, and a market stuck in limbo. Transactions slow down, not because homes don't exist, but because people are unsure of the rules of the game. The deeper issue is psychological. Policy shifts like this send a message. Things can change quickly. And when policy feels unpredictable, large financial decisions get postponed. That pause, that collective hesitation, is what turns a cooling market into a paralyzed one. If you're a homeowner or investor, the key now is planning, not panicking. Understanding how capital gains apply to your specific situation, especially timing and thresholds, could mean the difference between a strategic move and an expensive mistake. If this breakdown helped you see the market differently, drop a comment below with your city and whether you're buying, selling, or waiting. I read every single one. We put serious time and research into bringing you real insights like this. So if you value that, hit subscribe. It's just one click, but it helps us keep going. Number 2, investor pullback. The second reason Canada's property market feels frozen is the quiet but powerful investor pullback happening right now. For years, investors were a major driving force behind pre-construction condos, rental properties, and small multifamily homes. They provided liquidity, they absorbed inventory, they kept projects moving, but today many of them are stepping back, and that shift is sending shockwaves through the system. Why? Because real estate investors calculate everything. They look at expected rent, mortgage payments, property taxes, maintenance costs, and most importantly, after-tax return. When higher interest rates squeeze cash flow and new tax policies reduce potential profits, the numbers simply don't look as attractive as they once did. And when the smart money pauses, the entire market feels it. Developers suddenly face slower pre-sales. Condo assignments become harder to move. Rental investors question expansion plans. Even small landlords reconsider adding another property to their portfolio. The result? Fewer transactions, slower momentum, and rising caution. But here's where it gets interesting. This pullback doesn't mean demand disappears. Canada still has strong population growth and rental demand. What it means is that investors are becoming extremely selective. They're prioritizing cash flow positive properties over speculative appreciation, or they're favoring stable regions over overheated downtown cores. This shift changes the type of properties that move and the ones that sit untouched. If you're an investor, this is the moment to focus on fundamentals. Strong rental yield, conservative leverage, long-term strategy over quick flips. In uncertain markets, discipline. Now I want to hear from you. Are investors overreacting, or is this a smart retreat? Drop your thoughts below and tell me your city. We pour real effort into breaking this down clearly for you, so if you appreciate that, hit subscribe. It's one click for you, but it keeps this channel alive. Number 3, interest rates still elevated. The third reason the market feels frozen is simple, but incredibly powerful. Interest rates are still high. Even though many headlines talk about possible future rate cuts, today's reality is what buyers are actually facing. And today, borrowing money costs far more than it did just a few years ago. Let's break it down in real terms. A home that felt affordable at a 2% mortgage rate looks completely different at 5% or 6%. That same property can mean hundreds, sometimes thousands of dollars more per month. For many families, that's the difference between qualifying and not qualifying. It's the difference between comfort and financial stress. And here's the hidden effect. It's not just first-time buyers feeling the pressure. Move-up buyers are stuck too. If someone locked in a low mortgage rate in 2020 or 2021, why would they sell and take on a much higher rate now? They wouldn't unless they absolutely have to. So they stay put. This creates what economists call a lock-in effect. Fewer sellers list, buyers hesitate, inventory builds in certain segments while demand shrinks in others. The entire system slows down. Even investors are feeling it. Higher borrowing costs squeeze cash flow, making once attractive rental properties barely break even. When financing becomes expensive, risk tolerance drops sharply. Until rates meaningfully decline or incomes rise significantly, affordability remains strained. And strained affordability doesn't create excitement. It creates caution. In markets driven by emotion and confidence, caution can be just as powerful as a rate hike. Quick question. If rates drop tomorrow, would you buy immediately or still wait? Tell me below. We spend hours researching and simplifying this for you. So if you value that effort, tap subscribe. It's just one click, but it makes a huge difference for us. Number 4, the mortgage renewal time bomb. The fourth reason Canada's housing market feels frozen is something many people aren't talking about loudly enough. The massive wave of mortgage renewals hitting homeowners right now. Over the past few years, millions of Canadians locked in ultra-low fixed rates. Back then, money was cheap, payments were manageable, confidence was high. Fast forward to today, and those same homeowners are staring at renewal letters with rates 2 or even 3 times higher than what they originally signed. That difference isn't small. In many cases, it means hundreds or over $1,000 more every single month. That's what experts call payment shock, and it changes behavior instantly. When households face higher payments, they don't rush to upgrade their homes. They don't take on bigger mortgages. They tighten budgets. Some delay selling because they don't want to re-enter the market at higher rates. Others consider selling because they can't absorb the increase. Both reactions create instability. Here's where the freeze effect shows up. Buyers worry that distressed listings may increase. Sellers worry they won't get the price they want. Everyone waits to see how bad the renewal wave becomes. That waiting game slows transactions across the board. But this isn't automatically a crash scenario. Many homeowners build equity and have options, extending amortization, refinancing, or adjusting budgets. The key issue isn't collapse, it's uncertainty. And uncertainty makes markets cautious. If you're approaching renewal, preparation is critical. Start conversations with lenders early. Explore rate holds. Understand your payment scenarios before the deadline hits. Being proactive can reduce stress and protect your long-term strategy. Are you renewing soon? And are already feeling that payment shock? Share your experience below. Your story might help someone else. We put serious effort into breaking this down clearly for you, so if it's helping, hit subscribe. It's just one click, but it keeps this channel growing. Number 5, buyer psychology has shifted. The fifth reason Canada's property market feels frozen isn't just financial, it's psychological. And psychology can move markets just as powerfully as interest rates or tax policy. Right now, buyer sentiment has shifted from excitement to hesitation. A few years ago, buyers were rushing to submit offers within hours. Bidding wars were normal. Fear of missing out, FOMO, was everywhere. But today, that emotion has flipped. Instead of fearing they'll miss a deal, Many buyers fear they'll make a mistake. They worry prices could fall further. They worry rates could stay higher longer. They worry about job stability and economic uncertainty. And when fear replaces urgency, activity slows dramatically. This creates what's known as a wait-and-see market. Buyers monitor headlines. They analyze every economic update. They attend open houses, but don't make offers. Sellers sense this hesitation and become more cautious about listing. The result? A market stuck in neutral. Here's the important insight. Markets often turn not when conditions are perfect, but when confidence quietly returns. And confidence doesn't usually make loud headlines. It builds slowly. For buyers, this environment can actually create opportunity, but only for those who are financially prepared. Less competition can mean stronger negotiation power, conditional offers, and better due diligence. The key is separating emotional fear from personal financial reality. Ask yourself, are you waiting because it aligns with your long-term goals, or because the news cycle feels uncomfortable? In real estate, timing the exact bottom is nearly impossible. But buying when you're financially ready and when others are overly cautious has historically rewarded disciplined buyers. Right now, psychology is freezing movement more than fundamentals. Be honest, are you waiting on the sidelines or actively looking? Drop your mindset in the comments below. We invest real time and research into these breakdowns. So if you value that effort, hit subscribe. It's just one click, but it truly supports this channel. Number 6. Condo oversupply in major cities. The sixth reason the market feels frozen is the rising condo oversupply, especially in major urban centers. During the boom years, pre-construction condos were everywhere. Cranes filled the skyline. Investors lined up to secure units years before completion, betting on steady appreciation and strong rental demand. But today, many of those projects are completing at the same time, and the landscape has changed. Higher interest rates mean investors who plan to flip assignments are now struggling to close. Rental income often doesn't fully cover higher mortgage payments, and resale condo listings are increasing in certain neighborhoods, giving buyers more options and more negotiating power. When supply quietly builds while demand becomes cautious, prices don't necessarily crash. They stall. Units sit longer. Sellers reduce expectations. Buyers take their time. That slowdown creates the perception and reality of a frozen segment of the market. It's important to understand that not all properties are affected equally. Smaller investor-heavy condos in dense downtown cores are feeling more pressure than larger family-oriented units or freehold homes. Real estate is hyper-local. Oversupply in one segment doesn't automatically mean weakness everywhere. For buyers, this environment can create opportunity. More inventory means more choice. Or more choice means stronger negotiation leverage. Conditions, inspections, and price discussions are back on the table in ways we haven't seen in years. For investors, the focus must shift to cash flow strength, building quality, and location fundamentals, not speculative appreciation. Oversupply doesn't end markets. It resets expectations. And right now, expectations are adjusting, slowly but noticeably. Are condos in your area sitting longer or still moving fast? Drop your city and what you're seeing on the ground. We put real research and effort into every video, so if this helps you stay. Number 7. New supply isn't truly affordable. The seventh reason Canada's housing market feels frozen is the growing gap between government promises of more housing supply and the reality of what that supply actually costs. On paper, building more homes should solve affordability. More supply equals lower prices, at least in theory. But here's the problem. Today's construction environment is extremely expensive. Land prices remain high in major cities. Development charges have increased. Labor costs have risen. Building materials are still more expensive than they were before the pandemic. When you combine all of that, developers simply cannot build deeply affordable homes without losing money. So even when new projects launch, the price tags often shock buyers. This creates a disconnect. Governments announce housing initiatives, and expectations rise. Buyers hope for relief. But when units hit the market, they're still priced beyond what many families can comfortably afford, especially at higher mortgage rates. The result? Slower absorption of new inventory, pre-construction sales drag, developers delay future projects, and the cycle feeds itself. Another hidden issue is timeline risk. Many new builds take years to complete. In uncertain economic conditions, buyers hesitate to commit to something that may not be ready for 3 or 4 years. That uncertainty freezes momentum further. For buyers, this means opportunity may not always be in brand new builds. Sometimes resale properties in established neighborhoods offer better relative value. For investors, understanding cost structures is crucial because if developers can't build cheaply, long-term supply constraints may eventually support prices again. But for now, expectations and affordability are out of sync, and that misalignment keeps the market cautious. Do you think more supply will actually fix affordability? Or is it more complicated than that? Share your take below. We put serious time into researching and simplifying this for you, so if you appreciate that effort, hit subscribe. It's one click, but it helps us keep creating. Number 8. Government spending and deficit pressure. The eighth reason the market feels frozen isn't something most buyers see directly, but it quietly shapes everything. Government spending and rising deficits. When federal spending increases significantly, it often leads to larger budget deficits. To finance those deficits, governments issue more bonds. And here's where it connects to housing. Bond yields heavily influence fixed mortgage rates. If bond yields rise because investors demand higher returns to lend money to the government, mortgage rates can stay elevated, even if the central bank begins cutting short-term rates. That's why some people are surprised when they hear about potential rate cuts. But fixed mortgage rates don't drop dramatically. The bond market is forward-looking. It reacts to inflation expectations, debt levels, and fiscal policy stability. If investors worry that high spending could keep inflation sticky, yields remain firm. For the housing market, this creates uncertainty. Buyers wait for lower rates that don't fall as quickly as expected. Sellers hold off, hoping borrowing costs ease. Investors struggle to forecast long-term financing costs. It's not just about today's interest rate. It's about confidence in future policy direction. The important takeaway is this: housing doesn't operate in isolation. It's deeply connected to macroeconomic forces. Fiscal policy, inflation expectations, and bond markets all feed into the cost of borrowing. For buyers and homeowners, watching bond yield trends can sometimes provide better clues about mortgage rate direction than headlines about central bank meetings. Right now, deficit pressure adds another layer of unpredictability, and unpredictability slows decisions. Do you think government spending is helping the economy or quietly hurting housing? Drop your honest opinion below. We spend hours connecting these dots for you. So if this perspective adds value, hit subscribe. It's just one click, but it truly supports the channel. Number 9. Immigration versus infrastructure. The ninth reason the market feels frozen may sound contradictory at first, because Canada's population is growing rapidly. Immigration levels have reached historic highs, bringing hundreds of thousands of newcomers each year. In theory, more people should mean more housing demand and stronger market activity. So why does the market still feel stuck? Because demand is rising faster than infrastructure can handle. Newcomers need housing immediately, mostly rentals at first. But rental supply hasn't expanded at the same pace. Construction timelines are long, zoning approvals are slow. Skilled labor shortages delay projects. So instead of smooth growth, we get pressure points. In the short term, this creates tight rental markets and rising rents in many cities. But in the ownership market, something different happens. Many new arrivals need time to build credit, savings, and stable income before buying property. That delay slows the immediate impact on home purchases. Meanwhile, existing residents face affordability challenges, higher rates, and economic uncertainty. So while long-term demand looks strong, short-term transaction activity remains cautious. There's also a regional factor. Immigration tends to concentrate in major urban centers. That intensifies pressure in specific areas, so while smaller markets may not experience the same surge. The result? A complex imbalance. Strong long-term fundamentals, but short-term hesitation. For investors, this reinforces the importance of location strategy. Areas with transit access, job growth, and rental demand corridors may remain resilient. For buyers, understanding population trends can help identify neighborhoods with sustainable long-term growth. Right now, population growth is supporting the foundation of the market, but infrastructure limitations are preventing smooth expansion, and that friction contributes to the freeze. Are you seeing rental demand rise in your city, or is it cooling off? Drop your local experience in the comments. We put serious research into every video, so if you value these insights, hit subscribe. It's one click for you, but it helps us keep delivering. Number 10, policy uncertainty. The 10th, and perhaps most underestimated, reason Canada's property market feels frozen is ongoing policy uncertainty. Real estate thrives on stability. Buyers, investors, and developers make decisions based on long-term projections. But when rules keep shifting, confidence weakens. In recent years, we've seen tax adjustments, foreign buyer restrictions, rent control expansions, short-term rental regulations, stress test changes, and capital gains reforms. Each policy may have a purpose on its own, but collectively they create one powerful emotion: hesitation. Think about it from an investor's perspective. If you're unsure whether tax rules might change again, whether rent caps will tighten, or whether new regulations could impact profitability, you pause. And when enough participants pause at the same time, transaction volume drops. Developers feel this too. Large housing projects take years of planning and hundreds of millions in capital. If policy direction feels unpredictable, projects get delayed or scaled back. That limits future supply and adds another layer of caution to the system. Even everyday homeowners feel the effect. When headlines constantly discuss new housing measures, many people adopt a wait-and-see approach. They don't want to make a major financial decision right before another rule shift. Markets dislike surprises. Stability fuels activity. Uncertainty slows it down. The irony is this: policies designed to improve housing conditions can unintentionally stall activity if they change too frequently. It's not always the rule itself. It's the unpredictability of future changes. Right now, that unpredictability is acting like ice beneath the market's feet. What's the one policy change that worries you most right now? Drop it in the comments. I genuinely want to know your perspective. We invest real time and effort into breaking these complex issues down clearly. So if this helped you, hit subscribe. It's just one click, but it truly supports the channel. So here we are, 10 powerful forces, from capital gains tax changes to investor pullbacks, from high interest rates to growing policy uncertainty, all colliding at the same time. When you step back and look at the full picture, it's not hard to see why Canada's housing market feels frozen. But here's the deeper question: is it truly frozen, or is it simply resetting? Real estate moves in cycles. It overheats, it cools, it stabilizes. What we're experiencing right now isn't the explosive growth of the past decade, but it's also not a collapse. It's a phase of adjustment. Expectations are being recalibrated. Risk is being reassessed. Buyers are becoming more cautious. Investors are becoming more selective. And sometimes that pause is necessary. Markets built on rapid momentum eventually need breathing room. Prices that surge quickly often require time to align with income levels and economic realities. Confidence, once shaken, doesn't return overnight. It rebuilds gradually. The key insight is this: uncertainty creates fear for some, but opportunity for others. Disciplined buyers who are financially prepared may find negotiation power they haven't seen in years. Long-term investors who focus on fundamentals, cash flow, location, population growth, may quietly position themselves for the next cycle. And homeowners who plan strategically rather than emotionally can protect their stability. The Canadian housing market isn't dead. It's cautious. It's recalibrating. And eventually, confidence will return. It always does. The real question is, when that shift happens, will you be prepared?